Welcome to our presentation. Hello everyone, this is Ashifuchaman, my peering ID 2010537122. Today I will discuss about chapter 1, overview on credit risk management. Now I will discuss about introduction. As a result of the global financial crisis, international standard settings bodies and national authorities are reviewing and revising their expectation as to how banks identify, measure, monitor and control their risk management. Now I will discuss about credit risk as a range of possible outcomes. Credit risk arises from the potential that a bank's borrower will fail to meet its obligation in accordance with agreed terms, resulting in the negative effect on the profitability and the capital of the bank. Generally, credits are the largest and most obviously source of credit risk. However, credit risk could stem from both on balance sheet and off balance sheet activities, such as guarantees. It may arise from either the inability or an unwillingness to perform in the pre-committed contract manner. Credit risk comes from a bank dealing with household, small and medium-sized enterprises (SME), corporate clients, other banks and financial institutions. Then, in more technical terms, credit risk can be viewed as the existence of multiple possible outcomes when a bank, a loan or other extension of credit. The possible outcomes range from full and timely payments according to the contract, all the way to a complete absence of any repayment. And then, in this and all the subsequent section on credit risk management, loan is used as shorthand for all possible type of exposure to a single client or group of related clients. Now I will discuss about indicators of high credit risk. First of all, the level of loan is high relative to asset and equity capital. And second, the bank is highly dependent on interest and fees for loans and advances. And then, loan yield are high and reflect an imbalance between risk and return. And then, the bank has one or more large concentration. Concentrations have exceeded internal limits. And then, practices have resulted in a large number of expectations to the credit policy. And last of all, the bank has a large volume or number of classified loans. Now I'll discuss indicators of poor credit risk management. First of all, credit culture is absent or materially fluid. And second, strategic or business plan encourages taking on liberal level of risk. And then anxiety for income dominates planning activities. And then the bank engages in a new loan products or initiative with conducting sufficient due diligence testing. And then loan management and personnel may not possess sufficient expertise or experience. And then responsibility and accountabilities in the organization, administration or problem loan management process are unclear. And then concentration limits, if any, are exceeded or raised frequently. And last of all, skill throughout our organization or administration functions are low. And then my last topic is concentration risk. Now I'll discuss about concentration risk. Even if a bank organization and administration policies and procedures for individual loans are sound, a bank may have high credit risk or poor credit risk management if the loan book is concentrated. Concentration risk arises when any bank invests its most or all of the assets to single or few individuals or entities of sector or instrument. Banks need to pay attention to the following credit concentration risk areas. First of all, sector-wise exposure, and then division-wise exposure, geographically concentration, and then group-wise exposure, outstanding amount more than, and then single borrower-wise exposure, outstanding amount more than, and last of all, to borrower-wise exposure. Top 10 to 50 borrowers will be counted. Bank must establish internal limits to concentration across all the possible dimensions of concentration risk.
Assalamu alaikum. My name is Mohammed Adnan Chaudhry. My student ID is 201737123. Today I'll discuss robust credit risk management policy. First, we have to know what is this credit risk management policy. Credit risk management policy refers to a set of formal instruction, typically documented and approved by the internal government and within organization. Bank always have a credit policy, but what is really needed is a high quality credit risk management policy. The credit risk management policy is expanded from contains all of the elements that credit policy would contain and goes beyond this. It must be updated at least annually with board approval for this annual updates. Risk aptitude statement limits on loan type, provider type, and rating grade, industry or economic sectors. The necessary components of an adequate credit risk management policy. Risk aptitude statement. A risk aptitude statement defines an organization's level of risk acceptance and mitigation. It serves as a guide for decision making, ensuring that risks align with strategic objectives and capacity for handling potential losses. A robust CRM starts with a well-crafted risk aptitude statement. In this regard, the risk aptitude statement shall be approved by board and embodied in risk policy and delegated authorities. Risk aptitude is generally exposed toward both quantitative and qualitative means and should consider extreme conditions, events, and outcomes. It should be stated in terms of the potential impact on profitability, profitability, and liquidity, and should be consistent with the bank's strategic and business plan. Limits on loan type, or type, rating, trade, industry, or economic sector. The first task in the board is to establish in a sensible dispersion of the portfolio along the following line: agriculture, fishing, forestry, industry, trade, commerce, construction, commercial real estate, constitutional and land development loans, transport, consumer financing, loan financing, institutional miscellaneous. Other necessary components of an adequate credit risk management policy. The CP should clearly outline the bank's view of business development and priorities and the terms and conditions that should be applicable for credit to be approved. The CP should be periodically updated, taking into account changing internal and external QE custom. Significant deviation from the CP must be communicated to the senior management or board, and corrective measures should be taken. The CP should at least include a detailed and formalized credit evaluation process, credit organization, administration, and documentation process, formal credit approval process, risk identification, measurement, monitoring, and control risk acceptance criteria. There are also some much criteria that have CP should at least included. That's it for today. Thank you for listening.
Assalamu alaikum. This is Shakil Mondal. The last 3 digits of my student ID 1 to 4. Today I discuss about the general instruction of capital adequacy framework. At first, we try to understand what is capital adequacy. Capital adequacy refers to the minimum amount of capital of a bank or financial institution that must be maintained to absorb of loss and to continue functioning during the time of financial crisis. Aim. The aim of capital adequacy framework identify the optimal balance of a financial institution asset, liabilities, and risks. Capital to risk weighted asset ratio. Capital to risk weighted asset ratio is an indicator how well a bank can meet its obligation. The ratio compares the capital and risk weighted asset. It is used to protect the customer and promote the stability of financial system in the world. Capital to risk weighted asset ratio formula. The formula of capital to risk weighted asset ratio equal to total eligible capital divided by the summation of credit, market and operational risk weighted asset. For example, suppose ABC Bank has 10 million in trial 1 capital and 5 million in trial 2 capital, and it has a loan 50 million. The capital adequacy ratio of a bank ABC is 30 million. Therefore, the bank has higher capital adequacy ratio and it is considered to be safer. The minimum capital adequacy ratio is 8% of Basel II and 10.5% is Basel III. Scope of application. The guideline apply all the scheduled bank on solo basis and consolidated basis. Solo basis. Solo basis refer to the all opposition banks and its local and overseas branches. Consolidated basis refer to the all opposition banks as its subsidiary company which engage in financial activities like mortgage loan etc. Reporting requirement. CRA reporting. All of banks are required to submit the CRA report on the solo basis of the end of quarterly to Department of Supervision of Bangladesh Bank. ICAAP reporting. Each bank must be submit its internal capital adequacy assessment process report to Banking Regulation and Policy Department of Bangladesh Bank, both hard and soft format, with May 31 of the every year. So, thank you everyone.
Assalamu alaikum. I am Ashraful Islam. Last 3 digits of my student ID is 125. I am a student of Banking Insurance, University of Rajshahi. Today my presentation topic is managing credit risks in organizational process. Credit risk is a probability of financial loss resulting from borrower's failure to repay loan. Now I talk about how we avoid credit risks in organizational process. Here I discuss two components of avoid credit risks. First is borrower evaluation and second is risk-based loan pricing. Borrower evaluation have four tactics. Number one, internal risk rating system, which refer to analysis borrower repayment ability based on customer financial condition, cash flow, profitability, debt profile, and other function. Second is the role of credit assessment institution, which is recognized by financial supervisor, is responsible for evaluation of credit risks of claim held by bank. Another step is analysis specific borrower repayment capacity, which means the maximum amount you can spend on monthly repayment on loan based on your income and other outgoing. Final step is require loan documentation. In particularly, loan documentation refer broadly to the document needed legally enforce loan arrangement and properly analyzes the borrower financial capacity. Now we talk about risk-based loan pricing. It has two tactics. One is building block loan pricing, which means the process of determining the interest rate for granting a loan, typically as an interest margin over the base rate, conducted by the bank run. Final one is determination of selected component of risk loan pricing, which refer to consideration of is formulating an appropriate loan pricing strategy. There are cost, profit, and risks. That's all from my side. Thank you.
Assalamualaikum. Hello everyone. This is Farhala Jahan Israt. My student ID's last 3 digits is 126. I am a member of Group 3. Today I will discuss about managing credit risk in the organization process. My topic is approval authority, disbursement, and special case of related person lending. First topic is approval authority. Approval authority is basically that authority who approved customers' demand in banking sector. The approval authorities, basic authority principle, the authority to approve loans must be clearly delegated to senior credit executive by the board based on executives' knowledge and experience. Approval authority should be delegated to individual executive and not to committee to ensure accountability in the approval process. The second one is approval authority for large or complex exposures. The approval level of large loans and loans to be restructured must be escalated to the board. It is also best practice for any complex or unusually high risk loan to be escalated to the board for approval. And third one is exceptions. In certain limit circumstances, exceptions may be granted to the approval authority policy on a case-by-case basis. My second topic is disbursement. The credit administration should ensure that the credit application has proper approval before entering facility limit into computer system. Disbursement should be effected only after execution of charge document and completion of covenant and creating charge on primary securities and collateral. In disbursing loan, it is imperative that the borrower understand and acknowledge the purpose of the loan. My third topic is special case and related person lending. The relationship includes the ability to exert control over or influence banks' policies and decision making, especially concerning credit decisions. It is crucial for a bank systematically identify the track extension credit to related person uh, under no under no circumstance should a loan be made to related person on terms and conditions more favorable to that person than to any unrelated client. First, avoidance of undue influence on credit decision. The board and senior management must set the proper tone from the top in not pushing through loans on related persons that violate laws. Bangladesh Bank Guideline and Circular, the bank's on credit risk management policy, and the best banking practice. Second, avoidance of daisy chains and other devices to evade rules and sound practice in related person lending. The board and senior management will be held responsible for ensuring that the bank does not enter into so-called daisy chain or other reciprocal arrangements that are designed to evade the rules, aggregate limit, and sound practice in lending to related person. A daisy chain created when Bank A lends to related person or person of Bank B. Bank B lends to related person or person of Bank C. And Bank C lends to a related person or person of Bank A. A reciprocal arrangement is created when Bank A lends to related person or persons of Bank B and Bank B lends to a related person or persons of a Bank A. That's all for today. Thank you so much.
Assalamu alaikum everyone. This is Muhammad Alamin. My student ID is 2010837128. Today I am going to discuss about the topic which is financial stability. My topic are first credit risk mitigation, second collateral, and third party guarantees. Credit risk mitigation. Credit risk mitigation refers to the tools and strategies lenders we use to minimize the chances of losing money due to borrowers defaulting on their loans. There are several ways lenders mitigate credit risks. First, risk-based pricing, loan converts, monitoring borrowers, and limiting exposures. Second, collateral. For proper credit risk management, bank must keep track of which loans are collateralized by which types of collateral. For categories loans by collateral type is recommended. First, shares and securities. Second, commodities, export documents. Third, machineries or fixed asset or flat. Fourth, real estate. Fifth, financial obligation. 6. Guarantee to institution. 7. Guarantee to individuals. And 8. Unsecured loans. Amount and type required. It is imperative that the bank, when extending credit, demand the type which is credit risk management policy. The loan to value ratio must be low enough to absorb decline in the value of the collateral. It may occur with a small though and probability. Third is third party guarantees. The bank must understand that the risk on a loan is not eliminated by the extent of a third party guarantee. The bank merely substitute the credit risk of guarantee for that of its own client. With regard to guarantees, banks should evaluate the level of coverage being provided in relation to the credit quality and legal capacity of the guarantor. For following this, the corporate guarantee must be supported by memorandum of association or article of association, the company giving the corporate guarantee. The guarantee company must be rated of any investment guarantee by last one ECAL. Receptional guarantee arranged between two banks will be disagreed. So this is my presentation. Thank you everyone.
Assalamualaikum everyone, this is Jahid Hassan. Last 3 digit of my student ID is 129. Today I am going to discuss in front of you borrower follow-up and corrective action. We know that the conducting customer call and site visit is often difficult for the lender. For this reason, we think that the borrower must be go through the field for solve such critical situation and suggestion and timely communication. Reach out promptly to remind borrowers of the obligations such as payment or declines. And the second step is identifying issues, determining the root causes of any problem, whether it is financial difficulties or communication breakdown or other factors. And in the third step in borrower follow-up, correct collaborative solutions. Work together with the borrower to find the solution that are feasible for both parties, like the lender and the borrower. This might involve restructuring payment plans and negotiating terms. And the fourth step is documentation. Keep through all communication and action taken regarding borrower's situation. And the last step in the corrective action, continuous monitoring, regularly monitored by the lender of the borrower progress to ensure that the corrective action are effective. And the second topic of my independent internal loan review and changes to the credit risk rating. First, loan review versus loan monitoring. Loan review is a strategic process and staff function, whether accomplished by an objective third party, includes assessment and evaluation of individual loans, loan portfolios, components. And loan monitoring is a technical process on the other hand, and line function accomplished by a loan officer. It involves ongoing supervision of the borrowers in financial performance. And then the second step, objective of loan review. Objective of loan review is historical loan losses and recovery experiences, projected loan losses and recovery, review of problems loans and overall profit quality. And the chief elements of loan review is objectivity and credibility. In objectivity part, must follow the junior officer has to follow the decision of the senior officer of a certain firm. And the last step is the credibility.
Assalamualaikum and hello everyone. Before I begin, let me introduce myself briefly. My name is Imrit Tariqul Islam. I am a student of Department of Banking and Insurance, University of Rajshahi. My student ID is 2010537130. Today I am going to talk about managing credit risk in administration process. As we know, all banking activities are naturally connected with a risk. Well, I would like to start my presentation with highlighting some key points. That means what we will learn today. timely identification of problem assets. Why is timely identification important? How to achieve timely identification, and last, the role of provisioning in managing credit risk. At first, timely identification of problem assets. The term timely identification of problem assets describes the early detection of assets that are losing value or might soon lose their value. In order to control risk and preserve financial stability, this is essential for business and other financial institutions. Here's the breakdown of the concept: problem assets and timely identification. At first, problem assets: an asset whose value is impaired or at risk of impairment. This can be due to various factors like default on loans or a decline in market of investment. Then, timely identification. Early detection of these problem assets. The sooner an organization identifies a potential issue, the faster they can corrective actions to minimize their risk or losses. Then I am shifting my next slide. Why is timely identification important? There are several reasons why timely identification is critical. First, reduces financial losses. By taking early actions on problem assets, organization can prevent further deterioration in value and potentially recover some of the investment. Second, improves decision making. Early identification allows for informed decisions about how to manage the asset. This could involve restricting loans, selling of equipment, or writing down the asset value. Third, ensures regulatory compliance. Financial institutions, in particular, have regulatory requirements to identify and classify problem assets accurately. Timely identification helps them comply with these regulations. And last, maintains financial health. By effectively managing problem assets, organizations and other financial institutions can protect their overall financial health and profitability. Then, how to achieve timely identification? There are various methods for achieving timely identifications. First, regulator monitoring, early warning signs, data analytics, open communication channels, and staff training. This is very important to achieve timely identification. By implementation this strategy, a bank or financial institutions can increase their likelihood of catching problems early and minimize their negative impact of problem assets. Last, the role of provisioning in managing credit risk. Provisioning plays a critical role in managing credit risk, which is the risk of borrowers defaulting on their loans. Provisioning is a crucial tool for financial institutions to proactively manage credit risk, ensuring their financial stability and protecting the interest of depositors and investors. Here's how it is work: accurate financial reporting, regulatory compliance, loan portfolio insights, stress testing and scenario analysis, and last, building a buffer against losses. That's all from my side. I hope you all guys understand how to manage the credit risk. So I don't like to prolong my session at the moment. Thank you.
Hello guys, this is Azaz Ahmed Chaudhary. Today we are going to discuss about managing credit risk with appropriate MIS. In order to effectively manage credit risk in an organization, a management information system is essential. It allows for the examination of present and future risk exposure by giving the board and senior management access to up-to-date data on the segmented portfolio. Indicators to be traced and tracked. Monthly tracking of single and multi products at business level is necessary, using indicators like booking MIS, portfolio MIS, limit increases, withdrawals, attrition, delinquency, risk rating, and more. Segmentation of MIS. Segmentation MIS is a crucial tool for business to analyze loan portfolios by loan type, borrower type, rating grade, industry, and collateral type. This data helps track loss experience, estimate expected loss, steer management away from unprofitable lending, and allow for probability distribution. Factors to be considered for loss experience. Banks must track loss experience on loans disaggregated by factors like outstanding principal balance, estimated market value of collateral, specific provisions, cash recoveries, and gain or loss on sale of collateral. This data is crucial for better estimates of expected loss, steering the board away from unprofitable lending and constructing probability distribution for economic capital and risk weights. The quarterly data collection includes outstanding principal balance, collateral market value, specific provisions, cash reserve, cash recoveries, and gain on sale of repossessed collateral. Embedded losses in the loan portfolio. Sufficient data to quantify embedded losses in a loan portfolio that have not yet been recognized, particularly on loans that have been rescheduled or restructured. There may be a degree of regulatory forbearance concerning provisioning of problem loans time to time. Possible scenarios that banks should consider in carrying out stress testing include significant economic or industry sector downturns, adverse market risk events, and unfavorable liquidity conditions. So, this was my case presentation for the topic. I hope that it is helpful for you. Thank you a lot.
Assalamualaikum everyone, this is Rokunuzzaman. I am belonging in Group C. My student ID is 2632. Now I present you some parts of Chapter 7, Managing Risks and Problem Asset. Problem loans are a consequence of lending. At a time of loans, the founded unforeseen event that considered make it easy to the borrowers and leave it up to the term agreement. Interaction with the borrowers. Once potential loans has been identified, the banker need to follow up some steps. First, develop a preliminary plan before meeting with the borrowers. And second one is schedule the meeting with the borrowers after lending about the problem loans. It is the enough to letter of the printing in the how the borrowers has followed the various terms of the problem loans and represent the concern of the will satisfactory in the loan assessments and make the problem loans has been easy to the borrowers. Borrowers make it simply to execute the term and conditions of the letter. When the term and condition is fulfilled by the borrowers, the loan agreement will be furnished effectively. Now the second one is some document should be filed before taking the loan. The three comprehensive way and dimensions. The first of is types of borrowers, types of loan and credit facilities, and types of security agreement. Some general document should be filed before taking the loan agreement and making the loan agreement effective. The promissory note first of all, and second one is letter of authority, and third one letter of agreement, letter of credit, and the letter of referral, national ID card, photography of the borrowers, and the photography of the also the lenders, and problem asset managers, and liability of the borrowers, credit facilities of the CSR, and the agreement paper of the others. That's all about of my side. Thank you everyone for hearing me.